If you watch my videos, you know that I love Roth money. I just think it's a great idea. Tax-free money in the future, can't go wrong, right? Well, I'm happy to say that the US government has joined me in my love of Roth money by passing Secure 2.0. It's a very Roth-friendly piece of legislation. I think they're doing it for different reasons than the reasons I like it. We'll get into that, and we'll get into how it can affect you next. Hi, I'm Antonio Cibella with Vision Wealth Management. We're getting down into the details of Secure 2.0, a piece of retirement legislation that was recently passed. It's got a lot of changes in it. Today we're going to focus on Roth changes. Roth money, again, if you're not familiar, is money that's taxed upfront, and once it gets into the Roth vehicle, Roth IRA, Roth 401k, etc., it is not taxed again in the future. So it's not subject to income tax. Unlike traditional money, which was where you get a deduction when it goes in and it grows tax deferred and you pay taxes on the end, the Roth is the opposite of that. The Secure 2.0 Act has created some additional provisions to allow you to get money into Roth or to make you put money into Roths, depending on the circumstance. We'll get into that here in a second. And the reason why, well, I like it as a financial advisor because it will create additional sources of tax-free money for clients in the future. I think the federal government likes it because they get to tax that money now. That's my own opinion, but I think what it is that's not tax deductible money. That's money that gets taxed today. And so it helps with all of the budget projections and all of the big giant numbers that they produce, because if more people take advantage of these things, that's more money that gets to be taxed today instead of using a traditional vehicle. That's neither here nor there, but what does it mean for you? That's what we're going to talk about. And so the first thing that happened is Roth RMDs don't exist anymore in qualified plans. Required minimum distributions, a day that you have to start to take money from your plan. If you had money in a Roth 401k, for example, so this is on work or employer plans. You had money in the 401k, you're now subject to required minimum distributions, and some of that money was Roth money. You have to start to distribute it. You didn't get taxed on it because it's tax-free money, but what it did was it removed that money from the tax-free protection of the Roth, meaning any future earnings that would use if you didn't consume, if you didn't spend that money, are now going to be subject to taxes versus keeping them inside. Now, keep them inside. No required minimum distributions. You don't need the money? Don't take the money out. Leave it in there. Let it continue to grow tax-free for the future. So it eliminated required minimum distributions on company retirement plans. Roth IRAs, individual retirement accounts, did not have an RMD provision, so we didn't have to worry about that. The second big thing, it opened up the types of plans that can have Roth money. So once upon a time it was Roth IRAs. And then they said, well, hey, we can add Roth provisions to company 401ks. So if a company has a 401k or a 403b, we can let people put money in after tax. That'd be fine. And so there was a Roth 401k or a Roth 403b option inside of the plan. For small businesses, a lot of times they don't use 401ks because they can be cumbersome and expensive. They might use a simple IRA, or they might use what's called a SEP IRA, which is kind of like a modified pension IRA combination. Now, both of those have Roth options. So you can have a Roth simple IRA. If you own a company, that's great news for you because now you can get money in on the Roth side of the ledger. If you work for a small business and your retirement plan is a simple IRA, now you may have a Roth option going forward. That went into effect January 1, 2023. It'll take a little time for everybody to catch up and open up those options inside of the plans, but now it can exist. It's such a thing as a simple IRA Roth option, a SEP IRA Roth option, which is another good thing. Next provision, employers can match your contributions with Roth money if you would like. And so typically that wasn't the case. Even if you were putting money into, say, a 401k on the Roth option, the employer match was still coming in pre-tax on the traditional side because they were getting the deduction and that sort of thing. The caveat to this is that it's now going to be additional taxable income to you. That's how they worked out somebody's got to pay the tax on it. The company's not going to want to do it. So now it's taxable to you as an individual, that company match. And so if you ask them to match you in Roth, they should be able to match you in Roth, provided that your plan has a Roth option. That becomes more tax-free money in the future. Pay the tax now. Don't pay it later. Let the money grow tax deferred. Use it tax-free in retirement. That's why I like Roths to begin with. This is one more way to get more money on the Roth side of the balance sheet, is have the company match you in Roth dollars instead of traditional dollars. Couple of other things that come along with it. If you are over the age of 50 and you're doing a catch-up contribution, catch-up like I'm running fast to catch-up, not catch-up like I put it on my hamburger. If you're doing a catch-up contribution over the age of 50 in your company retirement account and you're a high wage earner in this case starts at $145,000. I believe it indexes up each year for inflation. If you made more than $145,000 from your company last year, for the purposes of this, you're a high wage earner. If you're over the age of 50 and you want to put more money in because you want to catch up for retirement, it has to be Roth money. Now, why would they do that? Well, if you're making good money, you're paying good taxes, and so they can now tax that money at maybe a higher rate if you want to catch up for retirement. That being said, still could be beneficial to you because you get more money in and you get it into a tax-free vehicle for the future. So that's a little bit of a weird one that they're making you put money into the Roth side if you meet those two provisions. Over the age of 50, high income, and you're using catch-up provisions, you're going to have to put it into the Roth side and pay the tax on it now. A lot of information in the video today. I know that was a lot of stuff. If I was unclear on something, go back, watch it again. If I was that unclear on it, you still have a question, shoot me an email, ask me about it. I'm happy to talk about it. Like I said, this is a big one. This happens semi-regularly where there are changes to the retirement landscape. That's why we do financial planning. That's the whole point of I'm going to work with somebody who understands my situation and can help guide me through this stuff. And so if you have questions about any of this, reach out to your person, find out how it affects you. If I'm your person, get in touch. If I'm not your person, you're looking for a person, get in touch as well. Thanks for being here. Hope you learned something, and I'll see you soon.